The Federal Reserve just made history, not because of what it decided, because of how divided it was getting there. Wednesday's vote to hold interest rates steady was the most split decision since 1992. 3 members of the Federal Open Market Committee wanted to strip out the bank's official bias toward cutting rates altogether. 3 out of 12. That has not happened in over 30 years. Jerome Powell, who chaired the meeting, called it near unanimous. The math suggests otherwise. What the 3 dissenters wanted is worth understanding. They were not asking to cut rates. They were asking the Fed to stop signaling future cuts, to drop the language that says the bank is still leaning toward lower rates. That might sound technical, but it matters. When the Fed signals cuts, markets price in those cuts. Businesses plan around them. Consumers borrow expecting them. If the Fed pulls that signal back, it is telling the whole economy, we are no longer sure relief is coming. The fact that 3 members pushed for that and lost means the internal debate is sharper than the public statement lets on. And then Powell said something that almost nobody caught, in real time. He looked at the assembled press corps and said quietly, "Thank you very much, everyone. I won't see you next time." His term expires next month. That was his farewell. No ceremony, no formal statement, no retrospective, just a single sentence at the end of a press briefing. That is how 12 years of Fed chairmanship ends, in a conference room, on a Wednesday afternoon. Let me explain why this matters to you specifically, not to Wall Street. To you, the Fed held rates because inflation is back above target. It rose to 3.5% over the 12 months ending in March. The Fed had been expecting to cut rates by now. That plan is on hold, and the reason it is on hold is not a mystery. Powell said it plainly. Prices climbed, he said, in part because of the war with Iran. That one sentence carries a lot of weight. The conflict in the Middle East is no longer just a foreign policy problem, it has become a domestic economic problem. Every American family is now paying for it, not in taxes, in prices, at the checkout counter, at the pump, in the airline booking screen. The war has a surcharge, and it does not ask your permission. Oil is trading above $125 per barrel right now. That is a 4-year high. The record, set in 2008, was $147. We are within $20 of it, and that number is not abstract. It shows up at your gas station, at your grocery store, and in the price of every package that arrives at your door. A Reuters analyst put it bluntly this week. The idea that somehow a consumer in the world will be insulated from this crisis is completely false. That is correct. Every economy touches oil. Everything that gets delivered by truck, which is most of what you buy, is getting more expensive. Jet fuel is expected to spike hardest. The airline industry is already warning about summer cancellations. Analysts are forecasting a staycation wave if the situation does not stabilize within the next few weeks. Think about what that means for an ordinary American. A family planning a summer trip, a small business owner pricing out shipping costs, a farmer calculating what it takes to get a harvest to market. The Iran war has embedded itself in daily life in a way that quarterly reports and geopolitical briefings never quite capture. When you pay more for eggs, for a flight, for a delivery, you are in part paying for a conflict in the Persian Gulf. There is no switch the consumer can flip. You cannot opt out of a trucking surcharge. You cannot choose to buy groceries that were not transported on diesel. The only real option most people have is to buy less, or buy cheaper, or stop flying. That is a real compression of living standards. It does not show up as a dramatic event. It shows up as a quiet, grinding tightening that people notice but cannot quite name. Now, about the Fed's next chapter. Powell is leaving. His replacement, Kevin Warsh, was cleared by the Senate Banking Committee this week. Warsh is Donald Trump's personal choice. He is a former Fed governor who served under George W. Bush, a former Morgan Stanley investment banker, and someone who has been openly and publicly critical of the Fed's sluggish response to inflation in recent years. His nomination has one clear implication. The next Fed chair will likely be more aggressive on rate cuts, more aligned with White House priorities, and less committed to the kind of cautious institutional neutrality that Powell tried, with mixed results, to maintain. That is either welcome news or a genuine risk, depending on what you believe is happening to inflation. If the Iran war ends, oil prices fall, supply chains normalize, and prices come down on their own, then cutting rates is exactly the right move. If the war drags on, if oil stays above $100, if inflation proves sticky, then cutting rates into it is adding fuel to a fire. Markets seem to be pricing in the first scenario. They are betting on de-escalation. Whether that bet holds is another question entirely. While the Fed was meeting, something else happened that deserved more attention than it got. Treasury Secretary Scott Bessent announced that the United States had seized nearly $500 million in Iranian crypto assets. The operation has a name, Operation Economic Fury. The funds were held primarily in stablecoins, Tether and USDC, dollar-pegged tokens that many people assume are beyond government reach because they sit on blockchains. That assumption is wrong. Tether and Circle, the issuers of these coins, have both stated publicly that they cooperate with law enforcement. They freeze assets when ordered to. That is exactly what happened here. $500 million. That follows a $350 million seizure last week. The numbers are escalating. This is not symbolic. This is financial warfare conducted in parallel with the military conflict. Iranian bank accounts, sanctioned assets, crypto holdings, all being targeted simultaneously. The economic pressure campaign is real and it is expanding. Against all of this, stock markets closed the week higher. The S&P 500 and Nasdaq both posted monthly gains. That sounds contradictory. A divided Fed, rising inflation, oil near a record, a war with no end date, and markets are up. Look at what actually drove the rally. The Magnificent Seven, Apple, Microsoft, Alphabet, Amazon, Meta, all reported earnings this week, all beat expectations. Meta had a blowout quarter. The artificial intelligence investment cycle that started with ChatGPT 3.5 years ago has shifted from a technology race into a financing race. The companies with the most capital are winning, and they are winning very publicly on earnings calls every 90 days, which brings us to one more piece of news from this week. Tim Cook announced he is stepping down as Apple's chief executive. Cook, who has run Apple for 15 years, made the announcement on the company's 89th earnings call. He said the timing was right. The business is performing well, the product roadmap is strong, and the successor is ready. That successor is John Ternus, Apple's head of hardware engineering. Cook said there is no one on this planet he trusts more to lead Apple into the future. 15 years. Cook took over when Steve Jobs was dying and the company's future was genuinely uncertain. He turned a hardware company into the most valuable enterprise in the history of capitalism. He expanded the iPhone into new markets, built out services into a multi-hundred-billion-dollar business, navigated trade wars with China, a global pandemic, and a complete silicon transition. And he stepped down on an earnings call almost as an afterthought, sandwiched between revenue figures. So, here is what this week actually looked like. The Fed split in a way it has not since 1992. Powell said goodbye at his last press conference, quietly, without ceremony. Inflation is sitting at 3.5% because of a war. Oil is $20 from a record high. The U.S. government seized $500 million in Iranian crypto under Operation Economic Fury. Tech earnings crushed expectations across the board. And the man who built modern Apple told the world he is stepping aside. Markets went up. That tells you something, not necessarily something reassuring, but it tells you where money thinks this is going. This is Andrew Meterich. If this gave you a clearer picture of the week, subscribe. I put out a new video every day.